Gold. For literally thousands of years, it's been the go-to for wealth and security. But how do you actually invest in it today? I mean, do you buy the actual physical metal, or do you go for a more modern digital version? Well, that's exactly what we're going to figure out. And that really is the golden question, isn't it? Do you want something you can hold in your hand, actual bars or coins, or do you want something you can buy and sell with a click, just like a stock? Let's break down the pros and cons of each so you can figure out which path makes sense for you. So, when it comes to gold, you've basically got two main paths. You've got the tangible asset, the real deal, versus a super flexible financial tool. Two very different ways to get in on the action.
Okay, so what's the real difference here, high level? Well, think of it this way. With physical gold, you literally own a piece of the metal. It's yours. With a gold ETF, you own a share that just follows the price of gold. You get the ups and downs of the price, sure, but you don't actually own the gold itself. Let's dig a little deeper into what that actually means for an investor.
All right, first up, physical gold. We're talking about direct legal ownership of actual bars, actual coins. You can keep it at home, you can put it in a secure vault. But here's the big thing, the real key takeaway. It exists completely outside the regular financial system. And for a lot of people, that independence is exactly the point. It's a huge part of its appeal. Then you've got the other side of the coin, gold ETFs. That stands for exchange-traded funds. The easiest way to think about these is like a stock that's designed to just mirror the price of gold. You can buy and sell them on the stock market instantly, just like you would with Apple or Tesla. Super, super easy. But again, and this is crucial, you're getting exposure to the price. You don't actually own the metal. And right there, that brings us to the fundamental trade-off, right? It's this classic battle between having absolute control and ownership versus just pure, simple convenience. So let's see how that really plays out when the rubber meets the road. Okay, take a look at this breakdown. With physical gold, ownership is direct. Control is absolute. It's yours. In a crisis, its security is super high because it's totally separate from the banking system. The catch? Yeah, storing it and keeping it safe can be a bit of a headache. Now, ETFs are pretty much the mirror opposite. You get indirect exposure, your control is limited to when the market is open, and its security really depends on the financial system staying stable. But man, the simplicity, it's off the charts. It's as easy as buying any other stock. Now let's talk about something called liquidity. It's a fancy word for how fast can I turn this thing back into cash. With an ETF, it's instant. As long as the market's open, you can sell your shares in a second. But with physical gold, well, that's a different story. You've got to find a dealer, arrange the sale. It just takes more time. And for some people, that speed can make a world of difference. Of course, nothing in life is free, and that definitely includes investing. Both of these paths have their own unique costs, some obvious, some kind of hidden. So let's unpack the real price of possession. Okay, if you go the physical route, you're not just paying the spot price of gold. First, there's what's called a premium or a markup from the dealer. Then you've got the ongoing costs, right? You either pay fees for a secure vault or you're shelling out for a really good safe for your home. And on top of that, you're probably going to want insurance to protect it. It all adds up. Now, gold ETFs have a different kind of cost structure. Every single one has an annual management fee. It's usually a small percentage of your total investment that you pay every year. Then you've got your standard brokerage commissions whenever you buy or sell. And, of course, if you sell for a profit, you've got to think about capital gains taxes. Different costs, but they're definitely there. All right, so we've looked at ownership, we've talked convenience, and we've unpacked the costs. So how do you take all this and build an actual strategy? The thing is, it's not really about which one is better in a vacuum. It's all about picking the right tool for the job you need done. You can think of physical gold as your financial fortress. Its main job, really, is long-term wealth protection. This is the asset you hold as a just-in-case against big economic shocks or runaway inflation. Why? Because its value isn't tied to the daily roller coaster of the stock market. Gold ETFs, on the other hand, they're more like your financial Swiss Army knife. They're the super flexible trading tool. Perfect for anyone who wants to jump in and out of the gold market easily, maybe to capitalize on short-term price swings, or just to get some quick, low-cost gold exposure in their portfolio without any of the storage and insurance headaches. So, do you actually have to pick just one? The answer is a big, fat no. In fact, a lot of savvy investors use both. They see them as two totally different tools for two totally different jobs. And that's what leads us to the hybrid strategy. It's a pretty clever approach. You use physical gold as your foundation, your bedrock for that long-term security. Then you use gold ETFs for more tactical short-term plays, taking advantage of how easy and cheap they are to trade. That way, you get the best of both worlds, the fortress-like security of one and the nimble flexibility of the other.
So what's the final takeaway here? The bottom line is the right choice really comes down to you. It all depends on what your financial goals are, what your timeline looks like, and frankly, what you're most comfortable with.
So I'll leave you with this final thought. The question you should be asking isn't which one is better. The smarter question is, what job am I hiring gold to do for me? Are you looking for that ultimate off-the-grid security blanket, or are you looking for a flexible way to trade the market? Once you have the answer to that question, the right choice for you will probably be crystal clear. I hope this helps you get a little closer to your answer.